Hey guys, it's Jordan. Today we are just coming on. We want to talk about the tax elements of this $3.5 trillion spending and reconciliation bill that is currently moving through Congress. Unless you have been on an island by yourself, you've likely heard some of the headlines about this new spending bill that's being proposed by Democrats in Congress. The bill's future right now is uncertain because of different factions within the party. They have different ideas about how large the bill should be and what should be in it. So some factions believe that the $3.5 trillion is not enough. It's just a good start, as most of the expenditures are toward an array of social programs favored by more progressive Democrats and the liberal members of the party. Other more moderate Democratic politicians have indicated that they will not support a bill the size of $3.5 trillion, that it is too large and results in a burden that the U.S. economy and citizens cannot pay for. So to help you understand the size of the bill, keep in mind that the federal budget every year is roughly $4.4 trillion. So it's a lot of money, right? So no matter your political persuasion, this is just a lot of money. At 1.5 trillion, 3.5 trillion, or even 7 trillion, all numbers that have been mentioned by different lawmakers, these are just big numbers that we're talking about. So the compromise is going to be somewhere in the middle, and it's not going to be where it's sitting at right now. It's probably going to be a little bit lower so that they can get everyone on the bill that they need to get it passed. So the original bill proposed new taxes of roughly $2 trillion to provide funds for the new spending. And in order to inform you, we're going to review the key tax increases in the proposed bill with the understanding that many of them will appear in the final bill as well. And we'll create a second video that will address the final tax increases once that final bill passes, and we assume that's going to happen in the next month or so. So let's start out with the corporate tax rate increases. So proposed effective January 1 of next year, the rate of taxes paid by corporations who pay tax, so that's C corporations as they're known in the tax law, currently it's at 21%, right? So the proposed bill would create a tiered structure rate starting at 18% for the first $400,000 of profits, 21% from 400,000 to 5 million in profits, and then the top rate of 26.5% on profits that exceed $5 million. So for companies which make more than 10 million in profits in any year, the lower two tax rates would be taken away so that all profits are taxed at that highest 26.5% rate. This change will mostly affect larger, successful companies, the ones that you currently buy from like Amazon, Best Buy, Walmart, Kroger, those kinds. With 5.5% of their profits quickly going away, they're going to have to make adjustments to find ways to pay for these taxes. So those who favor this bill will tell you that the competitive pressures from other businesses will cause them to not pass these additional costs through to their customers in the form of higher prices, that they'll simply just live with less profit. But there is another competition that is just as important to these large companies: the ability to attract investors who will provide capital to the businesses by buying their stock and helping to maintain their capital value in the market. So if profits drop at like company A, their stock sells off, that value decreases, and their ability to continue in business is hampered. So it's much more likely that the additional costs will be passed through to the consumers in part, because all these companies will have these higher taxes. Another likelihood is that employees' wages will decrease both by employing less people and paying less to the people that continue to work at the companies. So everyone will pay for this tax increase. It's simply a matter of how much of it will fall on each of the parties: the stockholders, the employees, or the customers. Let's move on to the second piece. So just other business tax issues that are within the bill. There are many that affect companies that have business operations in multiple countries. So those provisions are kind of beyond the scope of most of our clients. However, there's one additional business provision that will matter to some of you, so I'm going to mention it. There is currently a provision in the tax law that allows you to exclude up to 100% of the capital gains realized from the sale of a business in certain situations for business interests that are held for a number of years. So this provision is known as Section 1202 exclusion, effective for business sales after September 13th of this year. This maximum percentage is reduced to 50% for anyone with more than $400,000 in income. And as you might imagine, during a year in which the business is sold, it's very common to have more than $400,000 in income. Now let's move to how they're going to change some things with the cash basis of accounting. So proposed effective date when the bill is enacted, likely around the end of October, companies with less than $25 million in gross receipts can report their taxes using a cash basis. In essence, this generally allows them to defer taxes on any revenue that has not been collected by the end of a tax year. This bill will group ownership of companies that are under common ownership to determine if this tax method can be applied. All right, let's move down to individual income tax rates. They're proposing individual income tax rate increases, and the proposed effective date would be January 1 of 2022. So the current top tax rate for individual taxpayers is at 37%. The rate will be increased to 39.6% under this bill. Also, the amount of income that you make before this top rate applies will decrease, making the upper bracket apply to more people. So for example, a single individual will now begin to pay the higher rate at $400,000 of taxable income, which was previously $500,000. And a married couple would start paying that higher rate at $425,000 of taxable income, whereas it previously was $600,000 for a married couple. Let's move to capital gains rate increases. So the proposed effective date of the capital gains rate increases is September 13th, 2021. And again, all this can change, so we're gonna make sure we update you with another video very soon once the bill passes. But right now, the current top tax rate for long-term capital gains is 20%. They wanna raise this rate up to 25% under this bill. This rate will increase to 25% under this bill, and it's assumed that the brackets will also mirror what they will be in the income tax calculation as well. Next, we've got the net investment income tax. So proposed effective date isn't given yet, but it's assumed to be January 1 of next year. Currently, higher income taxpayers, they pay a Medicare surcharge of 3.8% additional tax on any investment income. So that's dividends, interest, capital gains. And they do this when income exceeds a certain threshold. So this tax will now apply to business profits as well as for these higher income taxpayers. So the taxable income threshold in the proposed bill will be $400,000 for a single taxpayer and $500,000 for a married couple. So next we'll move down to small business profits deduction. So this is referring to the Section 199 QBI deduction that was passed back in 2017. And the proposed effective date of this change would be January 1, 2022. So this is that one where you're getting the 20% deduction and you're only paying taxes on 80% of your business profits from a sole proprietorship, a partnership, or an S corporation when you meet certain criteria. So this reduction in taxable business profits can apply to all business profits subject to some limitations. Under the proposed bill, the profit reduction would be capped at $400,000 on an individual return and $500,000 on a married return. Now let's talk about a surplus tax rate. This is also proposed to become effective January 1 of 2022. There will be a new additional tax of 3%, which will be applied to any adjusted gross income in excess of $5 million on a single or a married return. Next, we've got estate taxes. So proposed effective date is unclear right now. Currently, there's a unified credit that applies to a lifetime gifts and estates at approximately $11.5 million per individual or $23 million per married couple. All this means is that if you don't exceed the per year gift limits, which is the $15,000, you have this lifetime exclusion. So if you get to the end of your life and you're a married couple and you both die, as long as your estate is below $23 million right now, there are no estate taxes that are applied at that. Now, if your estate is above that and you don't have any vehicles set up to escape that tax, then the estate tax would be applied into the excess. And the estate tax is large percentages. We're talking like 40%. They're trying to take this exclusion and reduce it down to $5 million per person, $10 million for a married couple under this new bill. So all that means is that the estate tax would be applied to more dollars. Let's talk about retirement plans. So the proposed effective date is January 1 of next year. So individuals who have accumulated large aggregated account balances, so we're talking over 10 million, they would be prohibited from contributing any further dollars to those retirement accounts if the individual's income is in excess of $400,000 for an individual or $450,000 for a married couple. Let's talk now about the required minimum distributions. They want this to go into effect January 1 of next year. So for these same large retirement accumulations, a minimum distribution of 50% of the amount over and above 10 million collectively. For both of these provisions, both Roth and traditional retirement accounts are considered. And if the total accounts exceed 20 million, then the required minimum distribution must be from the Roth accounts to decrease the total holdings to 20 million, or the entire depletion of the Roth accounts, whichever is less. This one is going to be something that you should definitely pay attention to because I know a lot of clients utilize the backdoor Roth. So with Roth contributions effective 1/1 of next year, currently, individuals who don't qualify due to having too much income to make a Roth contribution can in certain circumstances make a non-deductible traditional IRA contribution and then convert it to a Roth contribution, the backdoor Roth contribution allowed under the current law. So this technique would become prohibited in the new bill. So there you have it. And this is just a fraction of the tax provisions that are included in this bill. We will provide clarity when we get a final bill in the next few weeks. We'll welcome any questions, as several of these provisions may indicate the need for some planning to avoid the tax increases. So please do not hesitate to reach out to our office and discuss your situation. If you have any questions, leave them in the comment and we will get back to you on those. Thank you so much for watching. If you found this video helpful, please share it with your friends, like the video, and subscribe to the channel so that you are able to see all the videos that we put out in the future. Thank you so much for watching, and I'll see you very soon.